Welcome back to Stocks and Trades channel. We provide easy to digest information in short videos about stock market investing, personal finance, money saving, and building wealth. Our content is designed to help you achieve financial freedom sooner. Today's video will provide news, insight, and investment suggestions on the week ahead. We'll analyze 2+1 stocks to watch this week and some others that will be volatile. So, let's begin. Disclaimer. All trading involves risk. Only risk capital you are prepared to lose. Past performance is not an indication of future results. This content is for educational or entertainment purposes only and is not investment advice. The S&P 500 and the Dow Jones both posted gains of around 1% in the final week of 2021 after setting record highs on Wednesday. The Nasdaq was essentially flat for the week and was nearly 3% below the record it set a month and a half earlier. Despite the pandemic's persistence and rising inflation, 2021 was the third consecutive year of double-digit percentage gains for the S&P 500, and the index had posted 70 record closing highs year-to-date through Wednesday. Adding in results from 2019 and 2020, it's been the best three-year run for the major U.S. stock indexes since the three-year period that ended in 1999. The year saw wide disparities in U.S. equity performance at the sector level. Energy was the top-performing S&P 500 sector with a nearly 55% return, followed by real estate and information technology. Utilities generated the weakest result with a nearly 18% gain, followed by consumer staples and industrials. Historically, January's stock market performance has been a strong indicator of what may be in store for the rest of the year. In fact, 71% of the time the S&P 500 has posted a positive return for the year after gaining ground in January or has gone on to post an annual loss when the market has declined in the first month, according to S&P and Dow Jones indices. Our first stock type is dividend earning stocks. These are a great way to earn passive income. This week's suggestion is AT&T, with ticker symbol T. AT&T Incorporated is a holding company, which engages in the provision of telecommunications media and technology service. It operates through the following segments: Communications, Warner Media, Latin America, and Xandr. The Communications segment provides services to businesses and consumers located in the U.S., or in U.S. territories, and businesses globally. The Warner Media segment develops, produces and distributes feature films, television, gaming and other content over various physical and digital formats. The Latin America segment provides entertainment and wireless services outside of the U.S. The Xandr segment provides advertising services. Wireless is AT&T's largest business, contributing about 40% of revenue. The firm is the third largest U.S. wireless carrier, connecting 66 million postpaid and 17 million prepaid phone customers. Warner Media contributes a bit less than 20% of revenue with media assets that include HBO, the Turner Cable Networks, and the Warner Brothers Studios. AT&T plans to spin Warner off and merge it with Discovery to create a new standalone media firm. The firm recently sold a 30% stake in its traditional television business, which serves 15 million customers and generates about 17% of sales. This business will be removed from AT&T's financials going forward. Fixed-line telecom services provided to businesses and consumers account for about 20% of revenue, serving about 15 million broadband customers. The company was founded in 1983 and is headquartered in Dallas, Texas. John Stankey has served as AT&T's chief executive officer since July 2020. Some technical analysis data shows that AT&T's return on equity is 0.6%, its average volume is 52.88 million, its market cap is $175.67 billion, its beta is 0.67, its PE ratio is 190.7, its PEG ratio is 9.13 and its EPS is 13 cents. Despite our rating as 7, we consider this stock as a moderate buy. Based on experienced analysts offering 12-month price targets for AT&T in the last 3 months, the average price target is $29.22, with a high estimate of $36 and a low estimate of $26. With current price at $24.60, this would mean about 18.8% average profit over the next year. AT&T pays an annual dividend of $2.08, which amounts to a dividend yield of 8.46%. The ex-dividend date is the 7th of January, so buying an AT&T stock by then will pay you 52 cents on 1st February. The above analysis is not exhaustive and just presents you some important insights. We suggest using this analysis and carry out your own detailed research before taking a decision to open any position. Our second stock type is growth stocks. A growth stock is a share in a business that's shown above average earnings and has the potential to grow faster than the overall economy. This week's suggestion is Alphabet, with ticker symbol Google. Alphabet is a holding company, with Google, the internet media giant, as a wholly owned subsidiary. Google accounts for 99% of Alphabet's revenue, of which substantial revenue is generated from online ads. Google's other revenue is from sales of apps and content on Google Play and YouTube, as well as cloud services fees and other licensing revenue. Google also sells hardware products like Chromebooks, the Pixel smartphone, and smart homes products, which include Nest and Google Home. Alphabet's other bets business is comprised of moonshot investments in Access, Calico, Capital, GV, Verily, Waymo, X and others. Alphabet is the world's third largest technology company by revenue and one of the world's most valuable companies. The company was founded in 2015 and is headquartered in Mountain View, California. Sundar Pichai is Alphabet's chief executive officer. Some technical analysis data shows that Alphabet's return on equity is 30.2%, its average volume is 1.52 million, its market cap is $1.92 trillion, its beta is 1.07, its PE ratio is 27.91, its PEG ratio is 0.86, its EPS is $103.81, and its asset growth is 16.09%. Our rating is 10 and we consider this stock as a strong buy. Based on experienced analysts offering 12-month price targets for Alphabet in the last 3 months, the average price target is $3,368.75, with a high estimate of $3,925 and a low estimate of $2,965. With current price at $2,897.04, this would mean an almost 16.3% average profit over the next year. Alphabet's price performance has been driven by exceptional earnings growth over the last 12 months. Revenue rose 41% year over year to $65.12 billion, above analysts' expectations of $63.45 billion. In the meantime, profits rose 70.7% year over year to $27.99 per share, above the street's projection of $23.47. Furthermore, Alphabet's solid balance sheet and cash flow allow the business to pursue new growth projects while continuing to increase shareholder returns through share repurchases. The above analysis is not exhaustive and just presents you some important insights. We suggest using this analysis and carry out your own detailed research before taking a decision to open any position. Our third stock type is blue chip stocks. These are typically large, well-established and financially sound companies that have operated for many years and that have dependable earnings, often paying dividends to investors. This week's suggestion is Microsoft, with ticker symbol MSFT. Microsoft Corporation is an American multinational technology corporation which produces computer software, consumer electronics, personal computers, and related services. The company is organized into 3 equally sized broad segments: productivity and business processes, intelligence cloud, and more personal computing. Its best-known software products are the Microsoft Windows line of operating systems, the Microsoft Office suite, and the Internet Explorer and Edge web browsers. Its flagship hardware products are the Xbox video game consoles and the Microsoft Surface lineup of touchscreen personal computers. Microsoft ranked number 21 in the 2020 Fortune 500 rankings of the largest United States corporations by total revenue. It was the world's largest software maker by revenue as of 2016. It is considered one of the Big 5 companies in the U.S. information technology industry. The company was founded by Paul Gardner Allen and Bill Gates in 1975 and is headquartered in Redmond, Washington. Satya Nadella has been the chairman since 2021 and chief executive officer of Microsoft since 2014. Some technical analysis data shows that Microsoft's return on equity is 48.6%, its average volume is about 25.74 million, its market cap is $2.53 trillion, its beta is 0.87, its PE ratio is 37.62, its PEG ratio is 2.91, its EPS is $8.94, and its return on capital is 62.4%. Our rating is 9 and we consider this stock as a strong buy. Based on experienced analysts offering 12-month price targets for Microsoft in the last 3 months, the average price target is $370.23, with a high estimate of $410 and a low estimate of $320. With current price at $336.32, this implies a 10.08% upside potential over the next year. Microsoft is the second largest company in the world by market capitalization, and its annual earnings have climbed about 10% annually over the last 10 years to $176 billion as of 30th of September 2021. Over the last few years, it has continued to diversify its revenue stream, led by its cloud computing business, which is its fastest growing. In 2021, Microsoft announced plans to acquire Nuance Communications, an artificial intelligence company, to bolster its cloud computing business, and Xandr, a digital ad technology firm that it may use with various properties, including the search engine Bing. This tech giant has been a dominant player for 40 years and will likely continue to be one for many more years to come. The above analysis is not exhaustive and just presents you some important insights. We suggest using this analysis and carry out your own detailed research before taking a decision to open any position. Next week, many companies are going to release their earnings reports, which is one of the most potentially volatile times of the year for equities, and if we are not careful enough, we could put our entire portfolio at risk. Companies may announce earnings or losses and stock prices may go up or down significantly. For this reason, we suggest that you avoid or carefully consider opening a position for the following stocks during next week, and wait to evaluate the earnings announcement before deciding to invest. Jefferies will release earnings on Monday 3 January. BHP will release earnings on Tuesday 4 January. Stellantis will release earnings on Wednesday 5 January. Constellation Brands and Walgreens Boots Alliance will release earnings on Thursday 6 January. Finally, Acuity Brands will release earnings on Friday 7 January. Watch these stocks' prices carefully and think twice before making any decision. Next week will not be that popular among dividend stocks, but we have some interesting options to suggest. Monday 3 January is the ex-dividend date for Main Street Capital Corporation and Healthcare Trust of America. Tuesday 4 January is the ex-dividend date for Cisco, AECOM, Gap and the New York Times. Wednesday 5 January is the ex-dividend date for JP Morgan Chase and Keurig Dr Pepper. Thursday 6 January is the ex-dividend date for American Express, Bristol-Myers Squibb, MasterCard, and Oracle among others. Finally, Friday 7 January is the ex-dividend date for AT&T, Verizon, and General Mills. Be sure to buy any of the above stocks before the market closing of the ex-dividend's date previous day to benefit from the dividend payment. If you find this video useful, please like it, leave your comment below, share to a friend and subscribe to our channel. See you next time.